Cash flow forecasting explained, what successful founders know, and potentially this is what I'm going to go through today. So, my name is Alysha Randall from Fast Growth Consulting, and I run a fractional CFO company that helps founders establish a proper finance function, but also prepare for a raising round. So if that sounds like something that you're interested in, then do click on subscribe below. So today I wanted to go through cash flow forecasting in plain English, basically. So I wanted to go through how to forecast cash flow properly. So what to include, how to build it, how best founders use it to grow and make smart decisions. I am going to go through it in a bit of detail, assuming that you may have to do this yourself, or you may need to encourage your finance team to do this for you. Whatever it is, it's good for you to have a good understanding of the cash flows because cash is king. Cash is the most important part of keeping the business alive. So I'm going to go through some practical examples, some tips for startups and scale ups, and also what investors are looking for when they're reviewing your business and considering whether you're worthwhile investing in or not. So if you're a founder and you're operating without a cash flow forecast, I would say that you are running a big risk of running out of cash, and therefore this is really, really important, and ideally you should implement something quite quickly. All the businesses that start, as you know, a quite high percentage of them will run out of business, and one of the main reasons is because they've run out of cash. So if you can be quite proactive on managing your cash flows, just so that you can not run out of cash, then it's obviously going to help you. What I'm going to take you through also will help you with the day-to-day. It can be a proper leadership tool and not just a spreadsheet that someone builds and then forgets. So what is cash flow forecasting? So to explain it quite simply, it's just a plan that tracks all of the cash coming in, all of the cash that's going out, and then what's left at the end of each period. It doesn't matter if you're pre-revenue or if you're profitable. This is ideally about planning, control, and ultimately survival. So why do you need a cash flow? So the main reasons is it shows when you're likely to run out of cash, or it shows you it's getting quite low and you need to do something about it. It lets you spot problems early so you can do something about it. It helps you plan for hiring, for marketing, for stock or product builds, all of the different things that you want to do. Do you have enough cash to be able to do that? And it's what serious investors expect. And it also stops panic decision making. So profit and cash, they're not the same thing. They're quite different. So you can still be profitable on paper, but then run out of money. So I have seen this happen. This is not a fairy tale. So make sure that you really understand your cash, not just whether you're profitable or not. So whenever my team and I start working with founders, we always recommend founders start with two views. The first one is a 13-week rolling forecast. This is updated weekly. It's very close to reality. It's looking at it quite closely, particularly if cash gets quite tight. If you have a few million in the bank and you only spend a couple of $100,000 each month, then potentially you won't need this just yet. But it is sometimes good to at least start with this, especially if you don't really know where your cash goes. It's a good way of understanding quite clearly where your cash goes. And so it's very good to have this and review it on a weekly basis. The second version is a 12-month forecast. This is generally part of your overall budget. So if you have a budget, you should have your profit and loss, your balance sheet, and your cash flow within the budget, just like you would as part of your management accounts. So if you don't have a budget yet, that's fine. That's something we can help you with. But ideally, that longer term cash flow forecast is where you make your bigger decisions on resource allocations, and it's also what you take the investors through. The investors are interested in that bigger picture and that longer term view rather than that short term 13-week rolling forecast. So I wanted to take you through a cash flow forecast template that I share with my CFO students. If this is something that you're interested in, let me know. Just drop a note in the comments and we can send that over to you. But ultimately, this is something that either your finance, your bookkeeper, or your finance team can whip up in Excel. If you don't have a strong finance team or bookkeeper, then potentially may want to look at doing this yourself. Say your prior week, your closing balance. So say we put in at the end of the week, you had, let's say you had 856,000 in your bank account, as an example. And so then your opening position for the week commencing the 15th of April, 2025, you started the week off before any transactions with this amount. And then you go through what has been received and what have you paid out. So the way that this works is it's a combination of this is what's already happened and this is what I expect to happen. So today is the 22nd of May, 2025. If you say receive this at the beginning of this week, you would see that all of these items are completed as actuals. Again, ideally bookkeeper to do something like this. And then for the weeks going forward, you would have an estimate of what you expect it to be. Now, this obviously can be done in software. There is software out there to be doing. We are testing 3 at the moment. I can recommend our finance tech stack update. I send that to my CFO students on a biannual basis. At the moment, I don't have a full recommendation. There's a few that we're testing, but I don't love just yet. But what I do always recommend, if you haven't done cash flows before, I always recommend to just do it quickly in Excel and Google Sheets first, and then look around for a tool to add on top. This gives you the insight that you need, and it also, when you're implementing a software, you want to know what the outcome should look like. If the software just spits out a forecast, you don't have a good understanding of whether it's working or not, essentially, particularly with forecasting. The actuals, yes, I'd be comfortable because it's easy to confirm that it's what is in the bank account. But when you're confirming the future, it's a bit difficult. So ultimately, all your forecast is doing is looking at the actuals. Okay, these are all the things with money coming in. So it could be your invoice payments, or there's digital payments, so like Go Cardless, Stripe, PayPal, all these different types of things. Other incomes such as grants, maybe you're getting some grant money or donations or whatever it is. Interest, that's usually bank interest. So if you have cash in a bank interest account, there'd be interest. And then, of course, fundraising. So whether you've drawn down a loan or you've received money from investors, you would put that in here. So that would be all of your income. You can obviously add and change this to whatever's relevant to your business. And you would put in the positive amounts of what you received a month. So whatever that is, you would put that in here for this week of what's actually happened. And then everything else, all of your expenses. And the reason why these are broken out and why some of them are quite, there's quite a lot of them, is some of them are quite predictable. So credit cards come out on a monthly basis. Your wages and all the elements of wages come out on a monthly basis. Your contractors, again, come out on a monthly basis. VAT comes out on a quarterly basis. PPC, Google, social media, that might come out weekly or monthly. Marketing and people are usually the 2 biggest costs with startups and scale-ups. I have put a note for inventory if that's you. There's also cost of sales up here. You may have a rent direct debit that comes out the same time every single month. Other direct debits such as insurance or things that are deducted out of your bank account every single month. It's a line for other inventory. For subscriptions, generally, I recommend people put that in your credit card. It's easier to switch on and off than using a direct debit. So I've just made a note there. So that would be part of your credit card monthly deduction. And so the reason why I do it like this is because it's easy to say, okay, so around say the middle of the month, we have to pay our rent. So we know that it's come out here because it's already happened. We know that it's coming out here because it's already happened. And so then when we're looking at the future, we can say, oh yeah, it comes out on the 15th. So we just need to put it in on 15th every single month. And then you go to the next one. And so that is why I have so many expenses in here. Now with income, you may have the same thing, or it might just be all consolidated. I know with one of my clients, for example, they invoice enterprises. So for them, it's easier for them to break this down a bit. They know which enterprises pay on time, which ones are quite late, and so they can put in the estimates going forward of what they expect. Credit cards are the same. You might say, okay, on average, we get about £3,000. Obviously, you'll have the actuals, so you can always refer to the actuals. You might have, it's good to have about 2 months worth of actuals or even 3 months so you can see the trends, and then you just put in what you expect it to be. So like wages, for example, often come out around the 22nd of each month. The pension often comes out around the beginning, and then in the UK, your taxes for employees comes around the 20th, but it's for the prior period. So you can put all of these things in that have actually happened, and you update it on a weekly basis. And then again, you go through each line item and put what you expect going forward. Now, if you have someone like me, a fractional CFO, they would also be interested in how the budget is changing. So if with the wages, for example, you may have 3 months worth where they haven't changed much, but you know that you're going to hire someone that starts next month and they're going to increase the wage bill, for example. So this is a very detailed cash flow forecast. And once you've put all of the actuals in, the actual closing balance will be or should be the same as what you have in the bank. So that is what your bookkeeper or finance manager is reconciling to. So you know exactly the cash movements from 1 month to the next. So let's say, for example, we go back to the first month. So you received, say, an invoice payment of 100,000. Maybe you got a bit of interest. The other ones didn't really happen. Credit cards next week, so there's nothing there. We'll just keep that one zero. Oh, let's just say we had to pay a key supplier 5,000. Your pensions come out. You don't have US, so that's not applicable. Your tech contractors, say you have one that you paid this week. Finance contractors, you didn't have any. You had a legal bill that you had to pay that was, say, this much. VAT comes out quarterly. That'll be next month. PPC, you pay 5,000 a week, sorry. Facebook, Instagram, you do about 500 a week. I'm just making stuff up, as you can clearly see. Software subscriptions are those ones aren't relevant. I had to pay another 5,000 invoices. A lot of these things will be in your payment run. We had our insurance, monthly insurance come out. Our rent came out. And so we started off the week with 850,000. And because we got a big invoice payment, we finished off the week with 903,000. So that's basically all it is. It should be quite straightforward. It's just basically categorizing all the transactions in your bank statement. Again, this can be automated. You can quite clearly see that this can be automated. but it's good to go through it again just for a few weeks, even before you automate it, to see where everything's going. So it takes a little bit to set up. It probably takes your accountant maybe an hour or two to set it up, or yourself. And then you can start doing predictions to see where your cash is going. So I generally would also recommend scenarios, but maybe we'll save that for another day. It's quite can be quite complicated, and then we're really getting into advanced leadership skills. But I think if you're doing a lot of your bookkeeping in-house and you're quite a small company and you're not ready to hire a finance lead, I would highly recommend that you do this at a minimum so that you can see where your cash is going. You may have, your VAT may be huge, for example. I don't know. And so you have to make sure that you're ready for that kind of payment, and you'll be able to predict what it is in the future. You can always use the prior months, but then your balance sheet will tell you what it should be. And sometimes we have had to, this closing balance has got quite tight because we know, say, at the end of May, we've got a couple of million coming in for a fundraise. But by the time we get to, say, mid-March, we've only got about 55,000 in the bank. And then there is a wage bill here that we know is 50,000 that you absolutely can't miss. You can see when things are getting really challenging, and there's your negatives. So it's being able to predict what's happening is really, really important, because then you can move things and you can review. So you can say, hang on, our invoices aren't being paid. I need to start focusing on credit control. Or we're spending too much in this area. We need to refocus. Or, okay, we have to ask suppliers that we're going to be paying them a couple of weeks late because the fundraising money isn't coming in. Or we call up HMRC and say, can we get a payment plan on our VAT because we're waiting on fundraising money to come in and we can't afford it right now. So if you are able to do those actions and conversations early, it's much easier to manage than when you're, a week away from payroll and you can't afford it. So this is, as I said, a minimum recommendation for early stage startups. And again, you can automate this. You can get your bookkeeper to update it on a weekly basis. This is a monthly cash flow statement. I'm not going to go through how to put this in detail. That is your accountant's job. But ultimately, this is that monthly view. This is what a cash flow looks like. I do have a cash flow breakdown of what you should be looking at when you receive your cash flow statement from your bookkeeper or accountant. I will leave a link for that above and below. So if you have never seen one of these before, or you get a cash flow statement from your bookkeepers and accountants every month and you don't know what you should be looking at, check that video out and it goes through it in quite a lot of detail. As I said, put in all of your inflows, put in all of your outflows, have a couple of months, if you can, of a weekly view of what has happened in the past. It's then much easier for you to then forecast the next 12 weeks. You have that adding running balance at the bottom so that you can easily see when the cash dips and when you're in a bit of a danger zone. And this is why you want to review it on a weekly basis, because if those danger zones are happening a bit more regularly, you need to work out what you can do about it. So cash forecasting only really works if you're being realistic. So you don't want to assume that every single invoice gets paid on 30 days. You know that, well, in business that absolutely is not what's going to happen. So this is why you need to be quite realistic when you're putting in your income. So you really do need to think about what is my average customer payment term. Even though we say it's 30 days, they might all pay 45, 60 days on average. So put that into your forecast rather than the 30 days. VAT due dates and payroll due dates and any of your tax due dates are really, really important, obviously. Anything like hiring, So if you are hiring people, you do need to consider how much that's going to affect your payroll payments. Again, if you're finding that there's some danger zones, you may be able to delay some of the hiring and really consider if that is the good use of your resources while you're having a few challenges. And then you really do need to think about those large one-off costs. So insurance may be an annual charge, any annual licenses, any launch costs, any large travel overseas. You do need to think about the large costs that potentially you may be getting that's not in your history. And so having a look at your budget or what you're planning on spending over the next 3 months, do consider whether you've captured all of those costs or not. It's so often good to use comments or color codes in your spreadsheet when you're reviewing them, just so that you can understand a little bit of the logic. I just wanted to touch on scenarios. I often do build these into the cash flow forecast when I'm working with a founder, which is your base case. So what you realistically expect for your cash forecast to look like. And then underneath, I would have a stretch case. So if a few things that you're hoping will happen actually happens, then what does your cash flow look like? And then a worst case. So if the sales drop or delays happen or simply something like that, it's good to understand what particularly what worst case looks like, and then what you can do to mitigate. It just helps you prepare, and it gives you a chance to look at the options basically instead of panicking about what you're going to do next. As I said, tools, start in Google Sheets or Excel. You don't need software right at the beginning. If you don't have anything, just start with that in the same way that I've showed you. And then when you're ready, you can look for automation and visual dashboards. There are many out there, but again, probably my next tech stack recommendation, I will give a recommendation on some cash tools. There are loads of really expensive ones out there, but I'm trying to find ones that are really inexpensive but useful. So hopefully I'll be able to give a recommendation. If you have a good founders network, then potentially ask around or do a bit of a Google search. But I don't want to recommend. I know lots, of course. I just don't want to recommend a tool unless I love it. So I will come back to you on that one. So what do investors want to see? So if you're raising, investors really they want a forecast that links to your business model. So this is what I was saying. This 13-week one that you're just kind of managing, it's not something that I'd share with investors. It's the big one. So if you have a budget, you should have a 3-report budget. So it is your P&L, your balance sheet, and your cash flow forecast, and they all interlink. That is what they want to see. They want to see clear assumptions. They want to understand your current runway and cash burn. So current runway is how many months do you have left before you run out of money, and your cash burn is how much are you spending each month, essentially. What your plan is for using their capital. So if they're going to give you £5 million, what are you going to do with it? They want to understand the breakdown of what you're going to do with that cash, and a fallback options if things don't go perfectly. So founders who know their cash numbers, they're the ones that get taken really seriously. So how do you actually use your forecast? So this is sometimes where founders get a bit wrong. They build the forecast and then never look at it again. So ideally, you should be updating it weekly or monthly and reviewing it. Absolutely comparing it to actuals, because it's often very clearly, if I'm looking at a forecast versus actuals, you can see quite clearly if the forecast is realistic or not. You should be using it to steer your decisions. So you have a limited amount of resources, cash and time. What are you going to use that for? What is the best use of those resources? And then reviewing it before any major hires, major launches, or spending. Can you afford it, basically? So good forecast tools that work for you and help you steer your business. Just some red flags that I have seen in poor forecasts is invoices marked as cash too early, ignoring tax or VAT. They're huge expenses, so you can't ignore them. Overestimating sales inflows, underestimating team costs, no allowances for slippage, so there's no buffer in there. Sometimes it's good to have about a 5K buffer at the bottom. And no scenario planning. So if you spot any of these in your model, I'd recommend you fix it now. So that's kind of a high level overview of cash flow forecasting. It really is just building a model that just helps you make decisions. It is a valuable tool for a founder, and it just helps you control, gives you some investor credibility, and stops your business running out of cash. If you need help building a forecast that works for you and one you'll actually use, obviously reach out to me at fastgrowthconsulting.com. We'll leave some links below. You can book a free discovery call, and we also have some free guides there if you want to check that out. But thanks so much for watching. Don't forget to hit subscribe if you found this interesting, and I'll see you in the next video. Cheers.